Thanks a lot for joining us on ET Now. Let's start by understanding your call on Indian IT. We've observed that the valuations are being crunched a lot in the last couple of months for a variety of reasons. What's happening in US, Mr. Trump's stance, and then their own business models. Before we talk more granular, depending on the company we're talking about, let's understand your thoughts on the Indian IT services.
Sure. There are two things that are happening in the industry right now. The first is on just fundamentally how spends have changed. So we're seeing a situation where the run the business, the traditional spends are getting cut short or getting repurposed into change the business spends, which are more consultative in nature, which require the usage of new technologies, be it digital, be it the whole migration to cloud. Now, while the Indian companies are positioning themselves to take on these new projects, customers themselves don't know how to go about them. They're looking at a varied number of vendors, whether it be global vendors, new startups, boutiques, and obviously the traditional Indian vendors as well. So as a result of that, what we understand is that while overall IT budgets are growing, there's a reasonable portion of that that's getting repurposed into the new spends. And companies are now competing against each other quite aggressively to get a part of that new. At the same time, try to backfill that deficit that is being created due to the cannibalization of traditional spends. So, I think it's a phase where every company needs to understand how they want to go forward with. They need to reskill themselves. They need to create the right talent pool to take on the new challenges, and that obviously creates its own challenges as well. Mm-hmm. So that's what's happening on the fundamental side. On the other side, you have the whole change on the regulatory side, especially what's happened in the US. So there are talks about how potentially visa regulations could change, or it could become a lot more tougher. There could be a lot more scrutiny and oversight. While companies have the processes in place, they obviously need to start thinking about how the situation could look like, let's say, over the medium term. And as a result of that, we've seen some companies talking about increasing their presence in the US through local hiring. And that means creating a new bench, looking at creating a pyramid in the US. And comes with its own challenges, right. Because, movement of labor when it comes to local workers in the US is not as easy as movement within visa-based workers. Sure. And on top of that, you have the whole implications on utilizations. Sure. Because you're creating a bench, utilization levels do come down, and that has an implication on the way your business is going to get run. So I think these are the two challenges that companies are grappling with, and I think that's really the reason why we've seen some kind of a slowdown in growth rates for some of the larger IT companies.
Right. So two-part question then. One, how much more downside do you see in terms of valuations? The multiples some of the large IT companies, Indian bellwether, used to trade at, and now they've come down to, very low double-digit, or in some cases even single-digit multiples. And the other, how well are these companies adjusting to themselves to the changing environment? I mean, we were speaking to some of the large companies recently. They are moving gradually towards more digital, AI, analytical stuff. But how much time would it take for them to adjust?
Sure. So I guess if you look at your first question on valuations, valuations have obviously corrected, over the last couple of years, and that's nothing but a reflection of growth rates. So revenue growth rates are now sub 10% for the larger companies, and on top of that, you have some amount of pressure coming in on margins, partly led by rupee appreciation that's happened off late, and that's a new headwind that was unanticipated. Then on top of that, you're investing in the business, be it sales and marketing, be it new expertise that you're creating, or investments in new development centers, in on-site locations. As a result of that, profit growth is turning out to be lower than revenue growth. And hence, on an absolute basis, valuations do look relatively cheaper. But when you compare that with growth on the earnings side, they're actually not the same. The risk reward is not as favorable as it used to be. Mm-hmm. Now, having said that, yes, valuations have come off, at least at the beginning of this year. And these were pretty close to 2011 trough levels. We wouldn't look at 2008 because that was a global financial crisis. But 2011 was the last recent trough. And a lot of these stocks were actually trading at those levels. So we actually saw some amount of investor interest coming in, more from a portfolio positioning perspective. And hence, they were looking at specific stocks just because valuations were looking reasonable relative to, what was available otherwise in the markets. You have seen some amount of move up in the stocks recently. So to some extent, again, I think, the whole discussion is going to be, are growth expectations or is actual growth going to be better than expectations? And if yes, then those are the stocks to look at. I think your second question was on how are Indian companies positioning themselves. Well, I think there is a lot of talk about reskilling. There's a lot of talk about automation and the adoption of new technologies like artificial intelligence. But you got to keep in mind that these are still a small portion of your overall business. Yeah. So some companies have come out and said 20% of our revenues are new or more than 20, and that's growing at, let's say, 20% plus. But what that also means is that the balance, 70, 80% of your revenues are growing at a much slower pace because that's getting cannibalized. So, the dilemma that the companies face is that on one hand, you have a portion of the business which is small but growing fast. But on the other hand, you have a large portion of your business that is actually growing at a much slower pace. And how do you really balance both of them? At the same time, the traditional business is getting cannibalized because it's moving into the new part of the business. Mm-hmm. So I think companies that are able to just look at the next 5 years rather than just looking at the next 12 months are the companies that potentially can position themselves better for the way the industry is moving.
Mm-hmm. Now let's get a sense from you on how you're analyzing the commentary from some of these large companies. Yesterday, in fact, a couple of hours back, there was a whole furor, created over commentary from Mr. Praveen Rao. After the results of Tech Mahindra management said that massive amount of pressure on their margins for at least 2-3 months. How much is the pressure coming in from because of erosion in pricing or their negotiating capability being on the lower side? How are you analyzing all of that commentary from on that side?
Well, I think most companies have generally clarified that pricing is generally stable. Now, and when you talk about pricing generally being stable, we're talking about some of the larger verticals like PFSI or retail or manufacturing. Generally we've seen pricing for most companies, either being stable to down maybe 1% or so. And I think that's the same commentary that is being maintained for the next 12 months as well. While companies are finding ways to tackle, the kind of discussions that are happening with customers, because what customers are trying to do is that they're going back to vendors and saying, if we are renewing a contract, we would like that contract to be at a lower value than what it used to be in the past. And the reason is because they want those savings to be channelized into the new technology spends. And as a result of that, that creates the pressure on your traditional contract sizes. Mm-hmm. So the way to fill that is that one, you bring in automation, you bring in new ways of delivering services so that you can then manage your profitability on the contract, even though it's at a lower size. Mm-hmm. And then on the other hand, you want to have a sales engine that is firing on all cylinders so that not only can you win more of these traditional contracts and hence fill it up, but you can also win the new contracts, the new technology contracts, and that creates the referenceability for future project wins. So I think that's where the focus is right now. So we're seeing companies positioning on improving the sales engine. We're seeing companies increasing their presence on site because a lot of these new projects are now being serviced on site because customers are doing this more on a proof of concept basis. And then on the third, you're trying to bring in these new ways of delivering services to ensure that you can keep your margins within a tight range.
Okay. Mid-cap companies in the IT space are still continuing to witness a lot of interest from the institutional investor side. Some are kind of diversifying from the large big 4, 5 traditional companies to some of these companies in interesting areas. You would be having large coverage over the large ones, of course, but as somebody who tracks the space closely, which are the segments which are being addressed by these mid-cap companies, where you see more promise compared to the traditional segments?
So generally the mid-cap companies are trying to specialize right now because, the IT industry generally has been an industry where slowly and steadily the market shares have moved towards the larger vendors. And it's largely because the large Fortune 500 Global 2000 companies want to work with the largest vendors globally. So the mid-cap companies have realized that you need to create a niche for yourself. And they're trying to position themselves in different ways. So we've seen some mid-cap companies that are doing specialization in engineering R&D type of work. And hence, they're not just mere vendors, but they're actually becoming partners to their customers. Then we are seeing a new set of mid-cap companies coming in that are trying to position themselves as pure digital technology companies. So, when they go to a customer, they're not talking about application development and maintenance, but they're basically talking about cloud migration. They're talking about artificial intelligence. They're talking about automation. So that is their pitch to a customer. And then you have a third set of mid-cap companies that are basically cannibalizing the revenues of the larger companies. So they're going to the customer and saying, we haven't worked with you in the past, but this is what we bring to the table. Why don't you work with us? And hence they're taking away work from the larger vendors. They have nothing to lose, it's all to gain. So that's the way these companies are positioning themselves. Also, the mid-cap companies, the general risk with them is that they have large client exposures. So what we have seen is that if some of these large clients suddenly don't spend as much, it suddenly impacts your growth rates quite significantly, and hence valuations correct. So at the beginning of this year, a lot of these mid-cap companies were actually trading at reasonable valuations. And some of these companies have come out and talked about double-digit growth. With the endeavor to maintain margins or to grow margins. And I think that's the reason why there is growing interest in the mid-caps. So with reasonable valuations, double-digit revenue growth, a significant effort to ensure that margins remain with a tight range, you're talking about a situation where the mid-cap companies could potentially see better earnings growth than the larger cap companies. And that's the reason why there's interest in the mid-cap space.
All right. Thank you so much for chatting with us today.
Thank you.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.